Welcome everyone to the London session on TopstepTV. If you're new here, my name is Deeyana Angelo. I've been trading futures for 11 years, but I actually started trading 16 years ago, almost 17 years ago. I specialize in crude oil and gold, so mainly on that more commodity side of things. Now, before I do some plugs that we have to do, I am in a gold trade. It's doing a lot better than I thought it was going to be. And I'm going to explain the trade first before we get into the topic for today, which will be entering from things like 3-bar reversal, consolidations, and all of that. Cedric asked a very good question yesterday that was relating to that. So I figured that was a pretty loaded question, and you can literally spend an hour just talking about that. So the trade that I took here, you can see some of my markers. There was the Asia high that was located at 25.38 roughly. So I had a couple of hypos there. So if we had failed to make any traction above that, there is a setup that calls for a fake out during London. I call it sort of the Frankie fake out when it does happen, because Frankfurt is an exchange that does have some volume in it, but then when London starts trading, they usually reverse that move. So that was hypo number one. I was looking for maybe a gap fill, but at the same time, I knew that it was against the trend. So my second hypo was that we're going to have the breakout from the Asia range and then just shoot up with the trend. I didn't expect it to shoot up this much. I actually wanted to add a little bit more to this trade. However, now it's gone up so high that if I were to add at this point, it would completely mess up my average entry. If I was in with like 10 contracts, maybe adding like one, that would be okay, adding this far away from the entry. But whenever you're trying to add to a trade, and let's say you're trading one full mini, these are micros because it's a new XFA, but if you were trading one micro and we want to add two, that's 100% increase in your position size. And obviously if you're going to add it anywhere away from your entry, it's going to completely mess up the original idea, the original entry, original zone that you were looking at for your entries, right? So we don't do that, or we shouldn't be doing that. And if that's something that you're doing, what is happening is that you're just messing up the whole level. There's a reason why you might be looking for a trade. And then if that moves too far away, you're effectively invalidating that trade completely and just doing nonsense levels. So we're going to try not to do that. Now, I will be monitoring this. For now, it's a pretty strong trend up. And I may decide to take this off if it kind of starts to mess around. But we did close the sort of a big move down that we had from yesterday in gold. However, the overhead supply is the way I'm seeing it, is this zone that I marked up from yesterday. So we have a little bit of space until 48, really ideally up to 52s. And then we're going to see what's happening. But obviously, if it starts to slow down at any one point, I will do my best to keep my attention maybe focused a little bit more, because yesterday I missed my failed auction long during fast markets in crude oil because we were staring at ES. We were doing the house account, that's fine, and I was stalking it. Now with the failed auctions, if it coincides with any news coming in, it's going to be done in a blink of an eye, and that's exactly what happened. So I was getting ready, then I got distracted, the move shot up, and I was like it is one of the things that annoys me more than actually outright losing a trade. If you just lose a trade, you're wrong. You either got the time wrong, or you either got the entry wrong, trade location, right? But when you have a valid trade setup, if you go back, I even said I would like to long crude oil from around London lows. There's a demand there. That's what I'm looking for. I want to see a failed auction from there. And off it went. So, it's not easy doing the live streaming, the house accounts, there's a lot of stuff happening that you're trying to be entertaining and witty and everything. And, trades will be missed. It's just how it is. But yeah, I wasn't very happy with myself for doing that because I should have been more kind of zoned in. But I didn't sleep well. I couldn't sleep the previous night for some strange reason. I stayed up pretty late. I probably only had about 4 hours sleep, and obviously that impacted the way I was reacting. So it was too quick for me. Too many things happening, and it's like, yeah, whatever. But here we are. So next day, nice gold move up. This particular move that I entered had nothing to do with price patterns, right? I was looking for a breakout out of the first hour of the trading range, which in market profile is referred to as the initial balance. So that was the trade. Kind of like your opening range break, but we're using a full hour for our references for like when it's actually breaking. And then once you're in, you want to see it sustain above it. But beware, because most breakouts do fail. The only reason why this is like having a little bit more substance to it is because we have a very strong uptrend in gold, right? But if you were to look for a reversal, so if this gets up to some of my levels, you may see it start to turn around. This is where the 3-bar reversals or bearish engulfings or even equilibrium, so sideways movement, consolidations with resolution to one side can actually come into consideration. And there's several ways to sort of express your opinion in the market. Typically, I will wait for a slightly longer term time frame to show me the reversal. Why? Because if you're at levels that you've never been before for the day, and it's trending to that level, you're at risk of the price just running straight through it if you're in a trending day. So you need time to go by in order for the price action to kind of agree, or market participants to agree about that price, that's as high as we're going to go right now. And then you typically see the equilibrium, so the sideways movement, resolve to one side. That can come in the form of a 3-bar reversal. It can come in the form of a 4 and 5-bar reversal. So you have 4 candles like little soldiers that are distributing, and then they sort of reverse. So if we're talking shorts against this current trade that I'm in, that's one way to look at it. Another way is a 3-bar reversal where the price gets up there, consolidates maybe through a doji candle, and then reverses. So it's a quicker consolidation, equilibrium, whatever. And then the third one, the one that I actually really like the most, is a strong engulfing pattern. So it's a 2-bar pattern, not a 3-bar pattern, where you basically touch a very strong level, spend a little bit of time there, then reverse, and the price just, starts falling away from it. So some of let me find an example of that. So bearish engulfing. Okay, so here's a very strong one, which would have been difficult to play, so you would need some sort of a pullback. But the idea is that you effectively wait for the reversal. This is a 4-hour chart. It's a massive chart, but just imagine that this is like a 5-minute chart or something. This would be a pretty strong reversal, right? Why? You can have several types of engulfings. So when I'm looking at price action, I'm not just going, oh, it's just bearish engulfing. I want to see that the engulfing candle actually closes below the previous candle low. To me, that's a stronger signal than if we were to just kind of close it as we engulf the previous candle body, but we don't go below it. That's weak. And then the lower you go into the time frames, the lower the probabilities of that weak reversal signal working. So in effect, for low time frames, you need other helper things to actually make you find the right reversal. Otherwise, it's just noise. So you have to be very selective if you're just going to be looking at price action and nothing else. And now some of the ways to enter those trades. By the way, I'm also running this same trade in my live account, but with slightly less size there. So I'm being super mindful over the live account sizing. So in here, I'm in with like 5 micros. Over there, I'm in only with 3 because I didn't manage to scale in, which is okay. But let's talk about entries. Ideally, I would like to get out of this trade before we start talking. And, maybe I should just kill this and then we can kind of talk. But Yeah. So let's just, get rid of this, and then I don't have to like think things through. I mean, we're already at 1.8 R, I did use a bit of a wider stop on this, but again, it's a micro, so I was meaning to add up to like the full sort of 10 micros, which equates to 1 mini. So yeah, let's now focus on the price entries. But just before we get to that, I do have some plugs to do. So today, Thursday, during the main broadcast on Shoulder Tab, Ben is going to be doing Roast My Trades. So if you want to get your trades roasted, I'm going to give you the link for that. It's a great segment. I think it's very fun, and a lot of people get quite a bit of value from that. So there is the form. I don't know whether Bruno can maybe pin it or something. But yeah, that would be good. We're also going to have a replay of the amazing Linda Rashke interview. I absolutely love the woman. Like, I've been following her for many years now, and she's one of the few women in the industry that have managed to climb to the very top. She's a very, very intelligent woman. Her process is very detailed. I was watching the chat as she was on, and a lot of you could tell who were the newbie traders, right? They were all going, I have no idea what's going on. What is happening right now? I'm so lost. And it's like all she was doing is just, bringing out a spreadsheet rather than a whole bunch of fancy, nice, pretty looking indicators that everybody seems to be very used to now. And then she was going, well, I've got my data points. I've got yesterday's low, yesterday's high. I've got previous week's low, previous week's high. And yes, I do look at some other things, moving averages and stuff. But, that's all in the data points. And we have some very quant-based methods how we are, executing positions, and they're very simplistic conditions, which really, if you're going to trade through any kind of an algorithm, the mechanical system has to be in place, like 100%. So yeah, that is going to be available for replay. So I'm going to post that link in chat as well. So if you guys missed it, please be sure to watch it, and keep in mind that all she's doing is putting the data points, all of the data, RSI, blah blah, everything that you might want to use. She's just putting it in a spreadsheet. Like, I was a spreadsheet queen for many years before I had my software development company, and before we managed to create the lovely, Blotic indicators that help me automate everything. But her way is to automate things through a spreadsheet, right? And I think that's where the confusion was, because not many people would resort to spreadsheets, and it makes it, a little bit like, wow, what's happening? Especially if you're somebody who's not used to analytics and data and stuff, it can look scary. But at the end of the day, if you kind of just try to follow along with what she was saying, she's very detailed. Even though she claims she's not detail oriented, she just proceeded to give us a very detail oriented process. I found that quite funny. She's a great lady. She's incredibly smart, and there's a lot of stuff to learn from that interview. So yeah, let's go back to this topic of reversal patterns and strong versus weak reversal patterns, as well as actual entry points. Like, where the heck would you enter in these sort of trades? All right, so here we have a bearish engulfing on gold. If I kind of scroll down, this was a weak bearish engulfing. So as I try and teach you this, so remember, just a minute ago I said that the bearish engulfing, in order to be strong and a valid signal, is not just one red candle. It needs to close below the previous candle low. So this candle actually does not follow that, because it never closed below the low, right? Ergo, weak pattern. Ergo, no shorts, right? And look what happens. To me, anytime I see something like that, this is a failed attempt at a bearish engulfing. It's not valid. And 9 times out of 10, they're just going to drag the price slowly through that same level and then smash it. So very careful about how I enter those. But let's find a strong bearish engulfing. Okay, so here's one. Now this is more a 3-bar reversal, right? So we had a little move up. Let me see if I can maybe get rid of some of the stuff and then make the chart like super massive. So I'm going to get rid of the domes as well. I do trade through the dome, obviously. but just want to make sure that we're looking at, you know, a nice example here. All right, that should be big enough for everyone. So here's a 3-bar reversal pattern, right? A pretty strong one at that. Maybe mark that with like an eclipse or something. So here we go. Oh, I'm still getting used to how to use this thing. What have I done here? Okay, yes, here we go. Finally, we got there. So the 3-bar reversal is a pattern that can be in the form of either an evening star or a morning star for a long, or you can also have it as a pattern that is referred to as a 3 inside down. Like usually those are characterized by slightly bigger middle candles. So they're not like dojis. This one is more of a doji, right? And then it sort of falls away and creates a nice reversal. So there's several ways to get into this. Now, because this was such a strong fall away, you could just plop in a trade right as this candle finishes. You don't really want to trade before they finish. I know that Dakota said he will front run it, but he has very good levels, right? So he knows what he's looking at. If you're not quite sure whether a level is working out, that's another thing. You can't just have an isolated pattern. It has to make sense. It has to be at an area where you're looking for potential reversal, either because it's a previous day's low, or we have some supplies there, or, you know, something, or VWAP. I don't know, like anything just to stop you from going in purely based on the candle patterns, because if you have a candle pattern in the middle of nowhere, it means nothing, okay? Now, if you're finding any of this useful, do give me the likes, you know, click the like button. It all helps with the engagement. And obviously, we really appreciate it whenever you can support the channel for free just by clicking that like button. So that's your first entry, right? So you have immediate entry upon the close of the candle. Now, you have to look at your risk, right? So if you were going to enter this, well, what would your risk be? This is a 15-minute chart, and I think this was an out-of-hours move. So I'm just going to use like a little hacked Fibonacci tool to imagine that we're kind of entering a trade, right? So let's say that you entered this trade. So this would be your entry. This would be your stop. And it's like, how wide is that? Okay, it's about, 25, 30 ticks. That's pretty normal for gold. And then this one actually gave you a 1R multiples just over, let's say 1.3, 1.4R. Not a bad trade. So for me, this would actually be more of a scalpy type trade, because you're using a slightly smaller stop. You're going in off a nice reversal pattern, and that will be it. But sometimes when these third candles are too big, you may want to wait for an area either like 50% into that drop-off candle or breakaway candle, let's call it, because some of them will be longs. They're not all going to be shorts. It's just I found this example. So maybe look to go in at like the previous low of the previous candle, right? The low of the previous candle. And if that happens to align with 50% of the drop-off candle, all the better. Now, with some of the engulfing patterns that are 2-bar reversals, things get a little trickier, because you don't necessarily have the reference points of like, 50%, but there is something else, which I'm going to try and find. Okay, so here's a good example. Here's a bullish engulfing, so longs, right? This is the area that I'm referring to. So gold hasn't really moved that much far out, so that means time has gone by and we're not making any new levels. It could be that we might have a reversal at some point, but probably not. Probably not yet. We're going to wait for that. So bullish engulfing. So what is happening here? Well, the price falls down and kind of doesn't really consolidate because it still kind of kept going down. But then you have this quick move in the opposite direction, and same thing, strong bullish engulfing. What happened? We closed the engulfing candle above the high of the previous one. So that qualifies it as what? A strong bullish engulfing reversal, right? Now, typically, if you can get these to not be like massive, you can also just enter right at the close of the candle, and then your stop would pretty much be a little bit bigger, right? It would be like this. So this one is actually a pretty wide stop loss. It would need like 60 ticks in order to cover this, right? It's too wide. So how do we approach that? Well, this one was so strong that it did dip down. But some of the data points that I like to use is, yes, the 50% of the previous candle. Yes, the high of the previous candle, if it sort of matches up with that pullback. But also if you get a deeper pullback into the whole equilibrium shift, in order to speak, you know, in a way that would maybe make sense. So when you have a reversal, at some point you will have a common price point where the price makes up its mind and goes through to the opposite side. So the common price point, I actually have a name for that in my methodology, and it is actually the earliest point that you will be looking for in order to run a really nice trade with a limited risk. However, in strong trends, you may not get that. So where is that line? Just for, you know, for posterity, where is that line? So it's right about here compared to the pattern, right? So you get a bullish engulfing, and then you look for the open of the previous candle. So the open of the previous candle becomes that common price point where there was a market shift. Price shift. So the prices turn around, they go back the other way. Those prices will get revisited very frequently. And in fact, you can kind of see that in this mess from this move. So you had a bullish engulfing, right? That is absolutely humongous. And then if we mark off that market shift price point, you will see that this second candle after the bullish engulfing literally just touches it and then moves away. So that could be either another type of an entry when you have some slower markets, or you have some very big ranges that are not really going anywhere. So you can kind of do scalps from that. So in this case, this would be a scalp from this point of common price point. I call it the conterminous line because that's what it means, and then back up to VWAP. So that would be a scalp, range bound day. So you touch it, you see some movement, and you run it all the way to the nearest sort of mean reversion area. Now the third pattern that I like to look for is usually a consolidation of about 3 or 4 candles, followed by an equilibrium. So I'm just going to try and find those. Here we go. So there's a good one. Now these have several ways that you can enter them, but obviously gold is in a bit of a mood to just keep shooting up and up, and therefore it doesn't touch some of these more, let's call them more aggressive entries, because the aggressive entry would be something that might not get touched, but you're still like, oh yeah, but if I get that. Or is it an aggressive entry? I don't know. Maybe it's a conservative entry. Is it a conservative entry? Yeah, because the aggressive entry, I suppose, would be if you go in either way and then it just keeps going, but that can smack you in the face. Yeah, so I'm saying that that's a conservative entry. Yeah, so sorry, it's still a bit early in the morning for me. I did say many times that I'm functional in the morning, but sometimes I get things wrong because I'm still a little bit sleepy. All right, so yeah, conservative entry into the consolidations have several price points, actually, depending on the type of day that we have. And this is where something like Dolby's strategy can come in. But I have, a little twist on that depending on what the trend is doing. So if you're looking at a range in a 15-minute chart, so you have a clearly defined high, clearly defined low, and then another candle, the third candle that also goes nowhere. So it kind of like little soldiers, they're just standing there. We're like, yes, we agree on the price. Nobody's going anywhere. This is where we need to stop. So that's kind of the first sign that you may have an equilibrium in progress, a 3-bar consolidation. Now, the 4th bar, typically I would like to see the resolution of that equilibrium if I'm just going to use price patterns. Like, let's say I'm out and about, I don't have my full screen, I don't have Bookmap, I don't have any other way to look at the price developments. I will fall back to the actual price patterns. I'm actually really good at reading price patterns. I've been a swing trader for many years. In fact, for the first 5 years, that's all I did. And you need to know patterns. Like, there's no order flow there. You're banking on very large time frames to kind of carry over your trade over 2 weeks, sometimes even 2 months. And it was... it was crucial to actually read the price action patterns at the end of the day or throughout the day, 4-hour chart, all of that. So one entry that would be aggressive would be just to wait for the equilibrium to resolve and then to plow in. If you have a strong trend, you get a good pullback, that's actually a pretty valid way to do it. But keep in mind that obviously increases your risk, right? So this risk is massive, right? It's like you would need like 100 ticks to get into that. That's very painful. So because of the equilibrium being so potentially far away from the original consolidation area, you can take the same process of a bullish engulfing that I just explained, take that point of equilibrium break, aka the conterminous line, so common price point where we've seen the market shift. So you had a consolidation, you don't take the top and bottom of the range, you basically refer to the candle bodies, so not the full, you already had a breakout, and the market shift that happened was right at this point of the equilibrium break, which held to the upside. So what you could do is plop in a limit order there with a stop loss below the entire structure. So just don't do this. Don't do your stop loss right at the low, because what can easily happen if there is not enough momentum, they will go and take your stops, right? Because that's what they do. If the move doesn't have enough strength in it, they need more orders to get more momentum if they're going to keep going up. And this is why you see these stop runs. NQ loves to do those. You see a perfectly good reversal and then it turns around, snatches all the stops, turns around and goes back the other way. And you're just like, WTF, what was that? So this way, if you do want to position yourself properly, you need to position your stops with some room so that even if there is a stop run, you still have some space. I really dislike doing reversal trades with stops that run through the candle bodies or through any sort of wicks or anything. And every time I do that, it smacks me on the face. I did it during this combine when I had a perfectly good reversal trade, but I was stingy on the risk that I was prepared to put up. So I still went with the same size. I was in with, I think, 2 or 3 contracts. And I'm like, man, they're going to lose more than 700 on this. And then what did I do? I did this. What happened? It smacked me on the face, held the low, then reversed and continued to go to target. So I was like, yeah, Dee, don't do that anymore. And, trading is always about a continuous improvement, continuous introspective nature of how you're doing, what was done wrong, what could have been done better. And, you have to be objective, very difficult. If you don't have a mentor and somebody to guide the process, it's very difficult, right? But the whole point of this is that stop loss placement needs to be at a level where you're not going to be in as much danger of liquidity grab from the market makers in case the move doesn't actually have enough juice behind it. That is what the stop runs are. But obviously, retail traders, they go, hey, man, please stop, like 2 ticks below here. Oh, excellent. The market makers going, I know where all the retail stops are. Why? Because it's a logical point. It's not that they're watching your stops. Nobody cares about our sim stops, And even us in the live account, 1 and 2, 5, 10, 15 contracts, we're small fish, right? They don't care about that. They are the ones who move the market. We don't move the market. We just have to go along with whatever they're doing. So be smarter ponder about it, look at the structure, give yourself some room, and then how can we also limit more risk? Well, let's say that we do come back to this conterminous line. So we can come back to the common price point of the market shift where the equilibrium broke. So that would be your first point of contact. The next one, if you want to add, like you want to systematically add into the trade, is to then add into the equilibrium halfway into it, right? So you sort of loosely measured what the halfway point was, you add a trade there. If they go for the stop run, you can even have one aggressive entry into the stop run, effectively. And then you can kind of be just hopeful that the range is going to hold and stuff, and then at some point, like Dolby says it all the time, sometimes with the range plays, unless you're like staring at a 30-second chart, 1 minute chart, it's very difficult to be fast enough to get in on those moves. But the limit orders was how I used to do it when trading with size. So one would be placed sort of right at the point of reversal. If we go back to the conterminous line, I will place another one there, and I will place another one deeper into it. Typically, if I was already in with like 3 sets of contracts, I wouldn't go for the fourth one. The only time I would go for the fourth one is if we're still in a zone. The time of day is a little bit slow. Let's say it's lunchtime or something, and we're just very quiet. There's like nothing to push it too far along. And then you're just looking for that slow grind away from the level of interest. In that case, it's a little bit safer to scale in maybe 4th and 5th time within the zone. But generally, as a general rule, if I'm trading with some multiple contracts, I will only look to add 3 times. Now, sometimes I will only get one entry that is pretty aggressive, so right at the point of reversal, and then another one maybe 50% into this candle, but sometimes I don't even get that, right? Because today I was actually looking for the price to sort of not shoot up as fast as it shot up on gold. And I never got a chance to add. And that's fine. You just kind of roll with it. It's like, okay, well, the trade worked out. What else do you want? All right, let's see some questions relating to all of that. So that's literally, this is why I said it's a loaded question. See how long it took me to explain that, like, 20 minutes. So let's take some questions relating to all of this. Obviously, I've given you about 3 or 4 ways to enter, and also how you can average in around that reversal event. So Desmond says, actually there's another one before that. OPV0G says, Dee, do you ever use a trading stop feature? I'm not a fan of trading stops on my products. So crude oil and gold, they're quite temperamental, right? They're not instruments where once they make up their mind, they will trend for a million years after. It's kind of like you can sort of see a trend, but then intraday, it's very up and down. It's a very kind of V-shaped market. And any day that you take, bar like a very few isolated days, you will see that you will have one move down, then one big move up, then and trailing your stops, it's going to stop you out. Like, look at this one. Yeah, it went up. But how did it go up? Went up all the way, whipsawed down, then whipsawed into the candle, whipsawed back up, and then whipsawed back. Just like, you try and trail your stop through that, you're going to get slaughtered, man. Slaughtered. Like, you're going to be out of this before it even gets anywhere. And then it's not a valid trade. And, similarly, if you analyze this move, okay, this one is pretty smooth. But then if you're trying to add on a pullback, we're trying to trail the stop, you're already going to be out, like, probably somewhere around here, right? It's already kind of dipping into the candle and stuff. And on a very low time frame, this area would look like it's kind of breaking to the previous, to the opposite side. You just wouldn't be able to hold any meaningful trades doing that. And crude oil is even worse, man. Like, let's have a look at crude oil. Crude oil is a mess. Complete mess. But I love it, So take, the London move, reversal. This was the ADR high here, so we reverse from there. By the way, if we're looking at crude oil, we're arriving into the value low from London yesterday, which is somewhere around the round number of 70. Now, depending on what happens there, we might have a long for a value acceptance trade, but I don't like it that much because we do have a supply in the way. So if I go jump to the 4-hour chart here, I will show you what I mean. I'm not too crazy about doing value acceptances longs into supplies. So here is this whole supply area, right? I mean, it's massive as well, so that doesn't help. What do I need? I need a rectangle. Okay. So here's that supply. So value area is sort of comprised a little bit lower than that. So let's say this. If we start to accept this, even if we do accept this, there is a potential for recovery from yesterday's jump off a cliff and the previous day's jump off a cliff as well. But the issue is that anytime you have supplies in the way, unless there's a lot of power in the move, it's going to take time, a lot of time. So it's going to be one of those trades that really exhausts you. You know, you're looking for something, it's not happening, it's kind of going through it, but it's not really like that grinding, annoying, you know, you're looking at it, you're exhausted, you just want out, like, you know, just kind of put me out of my misery, man. Just like stop me out or whatever. But generally, you know, on my products, I'm not in favor of trailing stops purely because of how it moves intraday. These spikes that you see, even on good trending days in crude oil, they're still spiky, right? You'll still get these sort of events. So try and trail that, you know, it's not going to happen. So I don't like trading that purely because of the behavior of the instruments that I trade. You guys know, whoever's been here for a hot minute, that I don't really like NQ. Again, I said it on Fast Markets yesterday. Did you notice how Linda Rashke never once mentioned NQ? I saw it on the charts, but she never once said, yes, that's a great product to do. No, she said quite the opposite. If you're not doing well on faster markets and, you know, you're constantly in a dopamine drama, dopamine fiend looking for the next hit on NQ, because I think that's why people mainly trade it, they're dopamine fiends. You know, it moves so quickly that if you enter a trade, you will either be rewarded instantly, right? There's no delayed gratification whatsoever. And I'm somebody who, for my entire life, I've always been of the camp that, you know, if you rush things, it just creates nonsense, it creates rubbish in your life, with anything, not just with trading. So trading slower instruments can actually do wonders for your mental sanity. And I don't know how many people these days, you know, people get depressive thoughts and everything. Like, everybody's bloody depressed these days. I don't know what's up with that. Like this, so Granny D is going to go off on a rant now. So the new generations, I feel like they're not as resilient as the older generations, that they want everything right now, and if they don't get it, they just get into depression. And it's like, that's life, man. It's like, why are you getting depressed over something that's just a part of life? So I think we've kind of coddled some people this generation, and you know, my nieces are actually the same. You know, I don't think they can handle any real stress. They're afraid of job interviews. They're afraid of new things. They're afraid, like, everybody's afraid of everything, and everybody's offended by everything. It's like, you know, come on. And that's been reflected in the product that people trade now. So most of the younger people, they would gravitate towards NQ because of the amount of movement that it offers in like a blink of an eye. And it's like, yes, I was right. But if you're not profitable on NQ, consider something else. Consider a slower market. And Linda said it, corn. It's just so funny. She said, trade corn. So how many people are going to be trading corn now as a result of that? It has early closing time, so that's the only thing you need to remember about corn, and very heavily into seasonality. So maybe some, a bit of research about what a crop year is and when the harvest month is. That could provide a little bit of context around the fundamentals that could have the impact on the price movement. So it's not purely technical, but you can definitely use technicals in order to express your position in corn. So that's something I do with crude oil. But if you're going to trail your stops on crude oil, it's just, it's like 9 times out of 10, it's going to be very difficult. It just whips around. Very rarely just kind of has one movement. Like even here, we have a strong evening star. If you were to go into that and you get this movement, it just pulls back up. Like, look at this. 30-minute whip back up. So the pin bar, but still red, and we're still going down, but we're whipping. Well, and then we make up your mind. So you would have gone out of this trade like a million times if you were to trail it. It is temperamental. It's, I've been told crude oil is probably one of the toughest instruments to trade. And you heard Nick for a take yesterday saying, I don't know how you guys trade that. And I can't even trade it when it's really slow. So I don't like trading it when it's in 150 tick range. So I would want to see crude oil back at 250 at the very least, like 250 per NYMEX or London. I don't care. One of the sessions needs to give some oomph to it. And this is also why I've been trading it more. Right, we're going to see how this next candle ends in crude oil, and then probably will happen off stream, just looking at this, because I do need to wait and see what happens here. They are pushing with quite some power, so I like that. But at the same time, I would like to see some sort of a pullback so that I don't have to use too big of a stop loss. So as always, pullback to value low after the acceptance has happened is a good way to run a value acceptance trade. So yeah, that is definitely a possibility. London value acceptance long in crude oil with a view that we can position ourselves between 70. Again, not a signals class, but this is just what I'm thinking. Like, I'm just taking you through my thoughts here. So positioning ideally a little bit below 70. It's such a nice round number that if it does hold, that could be quite a good strong position. And then stops really should go at least at 69.70. So if I can somehow manage to get a good position out of it, that would be amazing. But as we know, markets have their own mind and they don't always follow what Dee wants to do. Just joking. Obviously, the only thing we can control is the entry and stop. That's pretty much it. We can't control the target. We don't know how much it's going to run, whether this thing is going to just turn around and smack us on the face because it decided that the supplies are still valid and we don't care about OPEC production. All right, let's have a look at some of other thing. Judas Joe says, do you know that what you call a failed bearish engulfing is referred to as a bullish order block in ICT terminology? Yes, I would be pretty honest. Everything that I've seen from ICT is concepts that have been done before, or like he's done a brilliant job of repackaging it. But the need to call things in a very complex way is what's bothering me. And then it's not necessarily a cohesive strategy. It's kind of like a whole bunch of separate setups that people are just supposed to pick and choose. So that's the problem that I have with it. It's a valid, I will always applaud anyone who tries to introduce price action and smart money concepts to any trader. So full props to Michael for doing that. And then, you know, we have the other weird stuff of stories and stuff and ramblings that I also don't care for. So why call a bullish engulfing, which has been around probably for about 300 years, something new? It's like, it's not new. It's been around. You know, I do call the Wyckoff things something different because I found it difficult to orient myself, right? That was the only reason. Otherwise, I would still say, hey, this is markup, this is liquidation, this is accumulation, distribution, blah, blah, blah. But as I was like trying to explain things to people, I'm like, distribution, accumulation. And I kept doing that. So I'm like, this has to stop. So how do I repackage this in order to make it clearer in my head? But I don't think that calling like single prints, FVGs, inverted FVGs, displacements, this. I mean, to be fair, displacement is a great word for a very big price movement. So, you know, don't get me wrong, I've watched some videos, but everything that he's talked about that already exists elsewhere. And it's much, much older, right? We have market profile single prints equal to fair value gaps, right? It's exactly what they are. So however you're going to spin it, whether you're going to call it an FVG, it's totally down to you, right? It's totally down to the trader. If you love ICT, if you found it very useful, go for it, man. Tanya trades, she uses it. She's a great trader, you know, but she's very selective and she is, you know, somebody who comes from a scientific background. Wasn't she like a research scientist as well? She's Croatian. I'm Serbian. You know, there's a Yugoslavian thing. She actually does speak what used to be a Serbo-Croatian language. Now it's Croatian and Serbian, but it's effectively the same language with a different dialect. And now some people are just going to come after me. It's like, how do you say that? No. But, you know, I was born in Yugoslavia. That's what I call it. And, you know, let's just leave it at that. But yeah, ICT concepts, if they work for you, brilliant. If they don't work for you, maybe you've gone too deep down the rabbit hole. So you need to maybe scale out, pull it back, get off the 1 minute chart and try and look at the bigger picture. I'm sure that Michael teaches I've seen him teach the multi-time frame analysis. I just don't know how many people actually pay attention to that, because they go straight to the 1 minute chart and the FVG. Like, how many times am I on the stream and somebody's screaming 1 minute FVG? Like, there's a reason why Market Profile calls for 30-minute FVGs, which are single prints, because A, they have a bigger profit margin. B, they are structures that have left in a gaping hole, a gap, right? And they need to be filled in. They need to be repaired at some point. So your job is to obtain a profit target that is, the best possible. So why look at, if you have 30-minute single prints, why would you look at the 1 minute? And this is what's happened that particular day. We had a perfectly good, very long sort of, 7-8 tick profit margin on a single print that was just beautiful, right? And then somebody's going 1 minute FVG. And I'm like, but you've got another one on a 30, like, why are you taking the most minute movement when the market is presenting you this lovely, how did Linda put it, cave to fill the cave? Look at the larger time frames. We have to put things in context. If there's nothing else, if you don't have the single prints on 30 minutes, if there's no single prints on 1 hour, nothing is visible, by all means go down to lose your eyes on a 1 minute chart, right? But put it in context. Don't be so zoomed into low time frames that you lose all aspects of larger time frames, right? So here I have 4-hour crude oil and I have 30-minute crude oil. What are they both telling me? The same thing, right? We have a reversal, we have a staircase formation on a 4-hour demands. So we go up, we consolidate, we go up again. In supply and demand concepts, they call this a rally-based rally. For this purpose on 4-hour charts, you might be able to use the market shift point after the consolidation, aka reaccumulation, if you want to use Wyckoff, at the second rally-based rally market shift point. You can. It's a large enough area. I would probably still want to see a reversal, but if you're looking to go into like some kind of a swing trade, then you would be looking for 69.34, which is the originating area where this move came from, right? Now, if it does go down there, because we've already visited it on the way up through a rally-based rally, there is a likelihood that we go a little bit deeper before we reverse. So you would need to kind of wait for a 3-bar reversal on a lower time frame. That is when the lower time frames do have its use. But without reliance on something else, all you're doing is just getting chopped up in the middle of nowhere, right? And you will have choppy days where it's, very difficult to read price action. We have NFP this week. It's always weird, right? It's not just September. It's not just thin markets. It's NFP weeks as well. Everybody's waiting for the biggest leading indicator so that we can see what possible outcome the Fed is going to think up next. All right, so Yarden says, Desmond Benson says that one time frame manifests a strong 3-bar reversal signal. Any time frame, all time frames work the same way, right? They are fractal. Markets are fractal. So the difference is in the length of the expected move. So if you're taking a trade from a 1 minute chart, unless you're super good with trade locations, and we're looking at a mean reversion trade somewhere, it's very unlikely that that trade from a 1 minute chart is going to last you for 3 hours, okay? Because it's too small, right? You're basing your stops on a 1 minute, you're basing it off reversal areas, and those are scalps. They should be lasting about 6 periods of the time frame that you entered. So you enter on a 1 minute, your expectation for trade length when it should be reaching your target is 6 periods, so 6 minutes. For me, because I trade on the sort of 5, 15, and 30 minutes, my expectation is that my trades are going to last anywhere from 45 minutes up to about 3 to 4 hours, depending on the setup. So have that in mind. Don't go over that because, then you're mixing apples and oranges. You're looking for a scalp, but then you want to hold it. It's like, it ain't going to work, man. Like, it's either a scalp or it's either a semi-swing trade intraday. Like, don't mix them. That's when people get into trouble. Oh, it's kind of at my target, but I'm just going to wait. And then it runs through them. Why? Because it's a short-term pullback, right? There are people who are excellent with short-term pullbacks, like Nick for a Tick. He was making money in those bull markets shorting it. That's some skill, man. That's skill, right? And yes, he did have a few, DLLs, but most of the time he was able to find those absorption of orders and icebergs and everything to the opposite side, and he would just snipe it, take his 10 points, and that would be it, right? So with Nick for a Tick, you see him, he trades NQ, but he's profitable at it, right? I have no problems with people being profitable in fast markets. But if you're not, that is when you need to be like, okay, maybe I should look for something else. And I know it hurts. It's like, stopping drinking or something, or giving up smoking. It's like you're giving up a vice. NQ is a vice. So yeah, any time frame, similar rules, except the further down I go, the more trending candles I want the engulfing candle to take out. So for example, if you see here, this was at the open, Globex Open yesterday. Crude oil shot up. If this was on a 1 minute chart, that would be a valid entry signal. And then it just kind of slowly trickled upside. But basically what you're looking at on 1-2 minutes is, and lower, like 30 seconds. I've seen people use like 15-second charts. So this is the thing that would apply. The bigger the engulfing, and the bigger the more trending candles that engulfing candle takes out, the stronger the signal, right? So that's the difference. On super small time frames, I would actually be looking for the engulfing to take out some previous trending candles. If it doesn't do that, it's a weak signal. But if we're talking 30 minutes like we have here, then any bullish, bearish engulfings that do close below the previous candle low, or do close above the previous candle high, they are good signals. And that is down to you to figure out whether it's gone too far, and therefore you would need too big of a stop loss, therefore you need a pullback. That's where the trade management comes into place, but you have your signal for entry. So you have a setup at the level, then you have entry, then you have how to actually enter, right? So entry signal is there, but do you go in immediately? Do you wait for a pullback into the pattern? Do you wait for a pullback to the original level? That's down to you, right? That's down to your style. Everybody, like, I've given you several ways to do that, but that is the gist of it. So you can now pick and choose, try them all out, journal the ones that you liked, throw away the ones that you don't like, okay? Personally, I use all of them on a case-by-case basis, but I would say that my main way of entering a trade would be a pullback to that market shift point, right? Yarden says it's hard with a 3-bar reversal because you have another one to the other way right before that you marked. How do I know which is the valid one? The one that comes from your level. So I couldn't give a monkeys what happened before I reached my level, right? So let's have an example that we can look for. Okay, so let me see. Let me drop down to 15 minutes, actually. Maybe we might find something else there. I always like to use a pretty good thing. So I think you're kind of getting locked into what came before sort of thing. So for example, if let's say that I was just spitballing here, so let's say that I was looking for short from some of these EMAs, because we did have an attempted move up, then it didn't, they just didn't really take it anywhere, whipsawed back down, and then you're effectively going in with the direction, first and foremost. What do you want to do? Do you want to buy or do you want to sell? If you want to buy, well, yes, you would be looking for a 3-bar reversal that came before, right? So it's not the best one because it has a selling wick. So again, it speaks to sellers being present. But then I know I want to be a seller, right? So you look for a bearish engulfing. I don't care that there was, some attempted failed 3-bar reversal prior, and even a successful 3-bar reversal, because that's not what I was looking at. I'm looking for direction, short, trade location, one of the MAs. I don't use MAs. This is just for directional feel. I don't use them as levels. I'm just using them as a example. It could be anything. It could be value low. It could be, VWAP. It could be anything that you're looking for as a reversal point. So what do you want? Are you a buyer or a seller? That gives you the first clue. So when you get that, you sort of filter out whatever is not in favor of that. This is where the discretion comes in. And you go in with the sentiment of your direction and the price reversal at the level that you wanted to visualize first, and then wanted to actually see happen. Once you get that happening, you then have your entry, right? So this is where the discretionary part comes from. And then you have your nice little trade all the way down, reach your targets, continues, blah, right? So that is the way to do it. So if you're getting too confused about, oh, but I had the opposite signal in the thing. Well, it's the opposite signal. You don't want to be a buyer here, do you? If you were a buyer, then that's fair enough. In that case, you get smacked on the face and then move on to the next one, right? And then you go, oh, I was wrong. Next. Thank you. Next. You sing a Ariana Grande song, right? Thank you, next. So hopefully that helps you, Yarden, to figure out which one is the right one. J-Hawk says, Dee, should we wait for market shift to happen in the higher time frame, or on the lower time frame can also be accepted? Well, if I'm looking for new price levels and I'm looking for the price to reverse, I would not be going in until I see at least a 15-minute bar reversal. At least, right? If I'm in a very strong market and I'm attempting to go against that move, I want to see a 30-minute reversal before I do anything, right? And if that happens to be a whipsaw and we don't manage to get a trade in, well, so be it, right? You have to accept the risk. You have to accept the loss even before it happens. And you have to be okay with it, So I personally wouldn't wait for a full market shift. Like, for example, this crude oil. Yes, we have a setup here. So what would my stop be? Okay, might be acceptable. I'm going to plop in just a 3 minis. So I'm not going to use the full contract again, new XFA. Where are my domes? Of course, I closed them. So let's get that back up. Let's do 3, see how this works. Testing a hippo. Testing a hippo. Get it together, Dee. And then we're going to see if we can get some momentum. Whoa, okay, this is weird. 35 ticks for a stop loss. If we manage to confidently close into this value, then this is probably going to be my London trade. But if not, then I'm only going to get smacked by 105. So not bad. I'm not going to be adding into this because I really don't like the supply. And I've already up on the day, so obviously if this loses, I'm not going to be too happy. Sorry, if I give it all back, it's not going to be a good one. So I'm going to try not to do that. Massimo says, we approach again. I know nothing about GAN. Okay, just want to do that. We approach a GAN angle which inverted the previous 2 tops. I don't know. Okay, Massimo, I'm going to be perfectly honest with you. I've never used GAN, never looked at it. I'm somebody who went into the industry in 2007, 2008 because a friend of mine was an institutional trader who immediately taught me the value of a decent trade location and the risk reward, low risk versus high reward and all of that. And I never looked at anything past price action, supply and demand, TPOs as I started to go intraday 5 years later. So I don't, like you would notice that I don't have an RSI on my chart. I don't have, MACD. I don't have any of that. I do have some moving averages usually in some shape or form depending on what I'm trying to look for. But I don't use other tools that are based on lagging indicators, right? For my entries, I look at the price on a horizontal level rather than a vertical level or any kind of lag, right? So if we have a perceivable trend, I will go with it, just purely because you're, kind of gluing yourself away from several moving averages, and VWAP, overnight VWAP, is what I tend to use for my orientation for that purpose. And then, the rest of it is all profile, how strong the auction is, value areas, lows and highs, initial balance edges, and my own average daily range, and like session range, average daily range. And sometimes I will even lower the time for the particular time of day that I'm looking at. Like, for example, if I'm looking at the first part of the New York session, I will lower the ranges just to see like how much movement we generally have in that time of day. So there are, proprietary things. I put huge emphasis on time of day when things should happen, and they do happen to a great frequency and high probability. It's things like a failed auction on crude oil usually happens after 10 a.m. Eastern, 9 a.m. Central. So not looking just as like an isolate. See, the problem with probabilities for some people is that they're not evenly distributed. So you're not going to have, like, let's say you have a 70% chance of a failed auction. You can run into several days that are a part of the 30%. But overall, when you're looking at the larger sample sizes, and, presumably you want to be doing this for years and years, not just like over the next month, you want to take setups that are higher probability. And if you trade long enough, you'll realize that the lower probability setups are just not worth it, man. Just not worth it, because they're like, trying to break out during, power hour, it worked once, it worked twice. And then, 2-3 weeks down the line, you're like, but it's not working now. Meh. And that's because you don't know the probability of that event, right? That's where something like Edgeful can be pretty helpful. But don't go too deep into a rabbit hole with Edgeful either, because it's only there, like, you still need levels, you still need, experience, you still need your trade entries, techniques, and you need to know what to do with the levels. It's not good enough to just have, oh yeah, Asia breakout brings a green day each time at the degree of 80%. Yes, it does. But what can happen is that you get a London fake out Asia break, and then a big reversal, and then throughout the course of the day it goes back up. So you need to be familiar with those intraday events and behaviors. All of that will play into your success as a trader, and that's why people's results vary wildly. All right, we're going to take a couple more questions. Reading Group says, morning Dee. Oh, good to see you. Recently, I blew up another XFA, and I made the decision to stop trying for now. I've come to terms with the fact that I don't have the needed personality to succeed here. Kind of sad. Okay, I would say that you're very good at talking yourself out of things, and I would say that this is something that people who do eventually succeed as traders do not do. You are probably not finding the biggest hindrance that you may have. You may be journaling the wrong way. Maybe you are good at negative self-talk and believing that negative self-talk. So I would probably work on the mindset first, and then seeing how you can be a bit more systematic. Blowing up an XFA, especially very quickly, usually means you've sized up way too much, you overtraded. So, if you're trading anything over 3 trades and you're blowing XFAs and you're trading minis because you want to be rich yesterday, that's the wrong approach, right? That is going to make you lose the XFA. So, why not go down to 1 micro and try to get some traction there? Just a little bit of a buffer, bit of a buffer. But don't talk yourself out of your goals, because you say you're kind of sad. But to me, that just says you've given up too quickly. If you noticed, all of us who are on-air talent and people who run the company, MP, Hogue, we've all had our share of the market beating us down, or even our businesses. Start a business, you put a lot of money into it, it doesn't work. What, are you going to quit being a business person now and go get a 9-to-5? Over my dead body, okay? That is my response to people who tell me to get a 9-to-5, or people throughout my life who told me to get a 9-to-5. Absolutely effing not. So you can go with me on this journey, or I'm out. And I think every single trader who has made it in life and business people, we all have that, right? We do not give up. We're like a dog with a bone, right? It's like, I'm doing this. Like, you can tell me it's impossible. You can tell me that I failed a million times, but I will succeed. Let's see what I'm doing wrong. Take ownership of the things you've done wrong. And you've done things wrong. Maybe you're trading the wrong product. What do you trade? Maybe that product is not the right product for you. Okay? Move on to something else. People are like, oh, keep blowing XFAs on NQ. Don't trade NQ. It's a very simple solution. Trade something slower. There's always a way around it, right? Is your risk reward positive or negative? And how does that risk reward relate to the number of trades you do? Do you do one trade at 1 hour and then do another trade at sort of 1 hour as well? And then you size up and you lose both of the hours that you made on the day. Do you do that? That's a mistake. You're supposed to be saving the profits that you've worked for, not giving them back because you want to size up towards the end of the day. So do the opposite, right? Do the opposite of everything that everybody has ever told you for trading. Trade less, not more, because more hours is not more money. Definitely not. Trade less trades with less size, get some consistency, and then very, very slowly start to size up. Getting into an XFA is a journey, and it's a difficult one. It's probably the most difficult thing you will learn to do. Like, imagine if you were training to be a surgeon, right? And it just so happens that under pressure, something goes wrong during like one of your first surgeries, and then you go, oh man, I think I'm going to give up now. It's like, no, you work harder. You work, you go to journal, you fish for your inefficiencies, your weaknesses. You find them and you tackle them. You don't give up. But at the same time, if you do give up, good luck to you. Whatever you do in your life next, I wish the best, obviously. But I'm just saying that people who made it in trading, they're the ones who don't give up. We all have a very competitive nature. In fact, quite a few of us got into a drawdown at the beginning of the year because they started putting numbers next to our names, and we're like, we need to be top 10. We need to be. And then we all started over trading like lunatics and got ourselves into a drawdown. And it's like, what are we doing? It's like, what is happening? And it's just the leaderboard. You have that, I have to be number one. I have to be. And you have to have that sort of an outlook in life, because trading, that's what it is. It's a competitive industry, so to speak, but in many ways you compete against yourself. You're not supposed to compete with other traders, in my opinion. But at the same time, there is that thing in the back of your mind. That's the devil on my shoulder, personally, where I need to be the best. I never do anything halfway. If Dee does bodybuilding, Dee can't just go to the gym and do bodybuilding just like that. No, she has to sign up for the fitness competition, and then another, and then win 7 of them. When I was a kid, I actually went to negotiate my first album behind my parents' back when I was 12, across the entire city, right? That's the kind of person that that you're staring at. Very stubborn. Dee does what she wants. You can either go along with it or she's going to do it anyway, right? So, that's the drive. That's the entrepreneurship. That's the need to break away from the norm, because let's be honest, you can't be normal and do this, right? So if you are somebody who craves security and you're okay with 9 to 5, like I said, all the power to you, all the best. But for me, that's kind of like giving up, rolling over, and saying, I give up. This is it. Never give up. All right, let's do one final. Oh, God. Okay. Naveen, I can see you in there. First of all, if someone does 150 to 200 trades per day, there is no effective way to journal. So, Naveen, I know you're with me in the payout incubator. Don't do so many trades. They're like, why are you doing so many trades? How many opportunities and moves do you have in one day? You're making yourself work very hard, and if you're not profitable doing that, I am not surprised. So lower that, please. Lower the frequency of trades. You're not an HFT, okay? And even if you were trying to do that, You don't have the power. The reason why HFTs are so successful, high frequency trading systems, is because they have systems that can, like, they have the size to move the market. That's how they have 90%, 97% accuracy and very long track records of never losing, because they're the ones who move the market. If you don't have that, why the heck are you doing 200 trades per day? There is zero way to fish for inefficiencies, to fish for weaknesses when you're doing 200 trades per day. So that's the first step. That's the wrong way to do it. We're not here to click buttons. We're here to make money. Okay? Discretion is one thing, but if you have one perceivable move and you're just getting up, down, up, down, up, down, trying to catch every minute momentum up and down, don't do that. You're going to burn out. Like, you're not going to be... Look, if I was doing that, I wouldn't be here. Like, and you're not a market maker either, right? Sometimes when you are a market maker, you have a certain amount of volume that you need to fill. And they give you like full kind of control how you're going to do it. You can do, several big trades, or you can do a million smaller trades. So even when I did briefly work for a market making company, my choice was always to do more size with less trades. And I would still fill the volume, but I didn't like that because you were always like, oh, I have to fill 2,000 contracts today. It's like, yeah, go away. But still, as a retail trader, you have no business doing 200 trades per day, man. No business. We're going to talk about that in the portal, but, there is no efficient way to review your trades. I'm certainly not going to be sitting in the portal reviewing 200 of your trades per day. Okay? You can be absolutely certain about that. And in fact, if that's the case, I'm going to refund you your cash now. Right? Because it is a paid service. It's a coaching service that we run for a very small number of people each month. With that, I'm going to end it. So enjoy the rest of the broadcast today. I will be on for Market Talking with Dee. However, this is the last London session for today. Don't forget, we obviously have new programming with Coach Jay at the buzzer. And we also have Nick for a Tick doing his Globex on Sunday opens. So yeah, I will see you a bit later today. In the meantime, try to not do too many trades, certainly not 200 before the NFP tomorrow, because there is no need. Save your mental capital for the following weeks. The next week we have the big boys coming back from their annual leave and summer holidays, summer vacations. So yeah, there's going to be a lot of action to be had in the run up to the elections and the Christmas period. Thank you for being with me. I really appreciate it, guys. I will see you later. Take care.